Welcome back, everyone. How well is your portfolio doing? That's a question all investors ask themselves from time to time. When you first start investing, you may find yourself asking this question pretty frequently, and you may also compare your personal return to other investors, or some of the popular benchmarks like the S&P 500 or the Dow Jones Industrial. There's nothing wrong with comparing your personal returns to those of others, or a popular index. But if you're going to rely on this comparison to make decisions about your investing strategy, you should first understand how portfolio returns actually work. Otherwise, you may find that the decisions you make may not really benefit you in the long run at all. What I'm getting at here is that not all returns are the same, and you should be careful about the comparisons you make, and most of all, allowing these comparisons to drive your decisions. There are several ways to calculate a return, and the methodology used to compute a return for an index is likely not the same as the one used to compute your personal portfolio's return. Most brokerages use a money-weighted rate of return to calculate the performance of your portfolio. Performance returns for benchmarks like the S&P or the Dow are measured using a time-weighted rate of return. While both methods are acceptable and can be compared, there are distinct differences in each calculation that may result in different outcomes. The money-weighted rate of return calculates the performance of an investment that accounts for the size and timing of deposits or withdrawals, while a time-weighted rate of return measures the compound rate of growth and eliminates the distorting effects of cash flows. If you are depositing or withdrawing money from your portfolio, you want to use a money-weighted rate of return because it'll tell you the impact of your cash movements. If you are not depositing or withdrawing money from your portfolio, then your money-weighted and time-weighted rate of return will be one and the same. I often see investors point to their year-to-date return shown in their brokerage account and compare that figure to the S&P 500. And whether it's higher or lower, it doesn't necessarily mean you are doing better or worse than the S&P, especially if you are actively contributing or withdrawing money from your portfolio. Understanding that when you make this comparison, you may not be comparing apples to apples is pivotal, because whether you accept it or not, making such comparisons tends to drive your behavior. If you see that your portfolio is outperforming the S&P, you gain confidence that the decisions you are making inside your portfolios are yielding positive outcomes. And if you find yourself trailing the S&P, you tend to worry and reevaluate whether your strategy is sufficient. Neither of these two scenarios is beneficial if you are comparing a money-weighted rate of return to a time-weighted rate of return. Therefore, I believe you are better off comparing your personal rate of return against the goal that you set yourself. So come up with a realistic goal and allow sufficient time before you evaluate how well your portfolio is performing. I know it's difficult not to compare ourselves to others or popular benchmarks. The internet is filled with people touting their great results, and financial news outlets highlight performance returns of popular indices constantly. If you're surrounded by this information, it's hard not to pay attention and make comparisons. Let me show you a simple example of just how misleading this can be. Let's use the performance results of the S&P 500 from this year. The year-to-date return for the S&P from the start of the year through month-end April was 8.59%. We can measure this ourselves very easily by taking the closing value of the index on April 28th, which was 4,169.48, subtracting from this value the closing value of the index on December 30th, 2022, which was 3,839.50, and dividing the outcome by the closing value from December 30th, 2022. This is the time-weighted rate of return for the S&P 500 index for the first 4 months of 2023. The simple S&P 500 price index is not inclusive of dividends, so if we wanted to measure the total return of the S&P 500, we could simply use the S&P 500 total return index. If we do that, we come up with 9.18% as the year-to-date total return of the S&P 500 through month-end April. You can easily find the historical value of both these indices on Yahoo Finance. For the simple S&P 500, you want to search for GSPC. And for the total return of the S&P 500, you want to search for SP 500TR. If you invested any amount of money into the S&P 500 at the start of this year and made no contributions or withdrawals, your return would be equivalent to those we just calculated. This would hold true regardless of the return methodology you applied. The time-weighted rate of return or the money-weighted rate of return yield the same outcome. So let's see what difference a few cash movements can cause. Let's say you started with $10,000 at the beginning of the year, and on February 1st, March 1st, and April 1st, you invested another $1,000 into the S&P. Your time-weighted rate of return would still be 8.59% without dividends and 9.18% with dividends. But your money-weighted rate of return would now be 8.32% without dividends and 8.63% with dividends. The difference is due to the timing of your contributions. Since the value of the S&P rose this year, and the index traded for a higher price on the first day of each month compared to its value at the beginning of the year, your newly contributed money would not earn the same return as your original investment. In this case, it looks like your personal portfolio is underperforming the S&P 500, since your money-weighted rate of return is lower than the return of the S&P. But if you think about this logically, It's impossible for you to underperform the S&P 500 if that is the only thing you are investing in. Let's look at another example. This time, let's assume you were a bit more lucky and timed the market a little better. Let's say you started the year with the same $10,000 investment into the S&P. Then on February 1st, you saw that the S&P was up 6% on the year, and you decided to sell half your original investment, or $5,000. And on March 1st, you saw that the S&P had fallen by 2.62% since your sale on February 1st, and you decided to put that $5,000 back into the S&P, and you made no additional contributions or withdrawals from your portfolio. Your time-weighted rate of return remains unchanged at 8.59% without dividends and 9.18% with dividends. But your money-weighted rate of return now looks a lot better, at 11.31% without dividends and 11.86% with dividends. So as you can tell, cash flows can make a large impact on your returns, but only if the cash flows are large in proportion to your portfolio value. If we change the starting value of our investment in the previous example from $10,000 to $1 million, and keep the same $5,000 sale on February 1st and $5,000 purchase on March 1st, our money-weighted rate of return would now be 8.62% without dividends and 9.21% with dividends, which is only 0.03% better than the time-weighted rate of return of the S&P. So in a small portfolio with large cash flows, the difference between a money-weighted rate of return and a time-weighted rate of return will be larger, and as your portfolio grows, the difference will become smaller. Most of us have portfolios that are made up of more than one security, and we probably make a lot more than 2 contributions or withdrawals per year, especially if you follow a dollar-cost averaging approach. The more cash flows you make and the more securities you own, the more complex your return calculation will be. Your brokerage will track and show you your money-weighted rate of return, and if you want to compare your portfolio to an index, you could track your own time-weighted rate of return for an apples-to-apples comparison. I let my brokerage track my money-weighted rate of return, but I personally track the time-weighted rate of return of my portfolio. While it isn't reflective of my actual return, it allows me to compare my asset allocation to popular indices like the S&P 500. This way, I can judge how effective my stock selection process is without the impact of the timing of my cash flows. I could also track a money-weighted rate of return of the S&P 500 with the same size and timing of cash flows as my portfolio, but that requires more time. Calculating a time-weighted rate of return is actually quite simple. All you need to do is compute the return of your portfolio each time there is a cash flow, and then simply combine all of the returns. I guess the moral of this episode is not to place too much emphasis on how your portfolio is performing against the S&P 500 or other investors for that matter. Everyone has their own unique cash flows, and for that reason, our returns will differ even if we use the same asset allocation. A more useful measure of success is to judge your portfolio against your own personal long-term goal. I hope you found this content insightful. If you did, I would appreciate if you gave this video a like to help me grow this channel. Thank you for watching and see you next time.